In this video, I want to discuss 5 money mistakes that the ultra wealthy never make. These are great money tips, and if you're able to avoid these common mistakes, what you're going to do is probably save thousands of dollars down the road. Now, mistake number 1 is buying daily use items individually, so here's Mark Cuban.
Hopefully we're all using toothpaste every day, right? A couple of times a day. And we're going to go through toothpaste every month, whatever it may be. You're better off buying 2 years worth of toothpaste when it's on 50% discount. That's an immediate return on your money. It's so hard to make a return on regular investments that you're better off when you see a sale. Any of your reusables, consumables that you have to have, when they're on a huge sale on Amazon, buy them, because chances are their prices are going to go up, but that's a real savings that you get to put in your pocket.
So I really like what he says here, which is if you're going to buy something that's super necessary and that you know that you're going to need later on, you might as well buy it in bulk. The idea here is that if you're able to get toothpaste, razor blades, or even toilet paper at a 50% discount, you're essentially getting a 50% return on your money, which is a super nice feeling. For context, the S&P 500, the stock market, typically returns about 8% a year on average over a long period of time, as well as credit card APRs are around 20%. So even if you pay off your credit card, you're getting about a 20% return on your money, which is still a lot lower than just buying things in bulk. Plus, think about all that time you save by not having to make that trip over and over again. You're saving time and you're saving gas and money. The worst money mistake here is to buy things at high retail prices, especially at fancy grocery stores. So for example, your Whole Foods of the world. So instead, go to places like Sam's Club or Costco, or even check out the best deals on Amazon and Walmart.com. Also, as a bonus, if you're a Costco cardholder, it's a great way to pick up the ladies.
That was Raymond Stions who got the foot stepped on. Bill Covington Jr. had a footstep. Raymond Stions who got the foot stepped on. Bill.
Now, by the way, that wasn't even the executive membership, so imagine what this thing can do. Mistake number 2 is impulsively spending. So a lot of smart billionaires are actually surprisingly frugal with their money, and it's one of the ways that they actually accumulated all their wealth. In fact, Sarah Stanley, the author of The Next Millionaire Next Door, surveyed over 600 wealthy individuals in America and found that they all had 3 similar traits, and one of which was being frugal and not spending excessively. Now, we can actually see that evidenced in some of the top billionaires in the world. So for example, Warren Buffett, the chairman and CEO of Berkshire Hathaway, still lives in the same house that he bought for $31,500 in 1958. So that home today is worth about $650,000, which still seems like a lot, but compared to his net worth of $108 billion, it actually only represents 0.0006% of his actual net worth, which is pretty dang low. I'm big into watches, and I personally have some watches in the $1,000 price point region. So for example, the Omega that I'm currently wearing. However, Bill Gates famously wears a Casio watch, and that is something that you can literally buy on Amazon for $46. So is it probably a mistake that I'm wearing a watch worth thousands of dollars? Well, according to them, yes, it probably is. However, this watch was a gift from my dad to me about 10 years ago, so I still like to think I'm being a little bit frugal here. Lastly, just another example of frugality, the late IKEA CEO, his name was Ingvar Kamprad. He usually rode the bus and flew economy class on airlines, even though himself, he was worth over $50 billion. So this is just to say that if you have the option of spending more versus spending less, typically the ultra wealthy like to spend a little bit less. All right, mistake number 3 is succumbing to lifestyle creep. So there are plenty of people that are making over 6 figures these days, and they still live paycheck to paycheck. That's actually possible. I know that sounds incredibly absurd, but imagine you make $150,000 per year. Your net pay in California will be just over $98,000 a year, or about $8,167 per month. If you rent a place for $3,500 a month, which is not unheard of here in California, and you have a car payment of $500, well, that's already $4,000 gone of your net pay. And then you add in car insurance, eating out at fancy restaurants, perhaps shopping at a designer store, and maybe you get a massage or a facial every now and then. You can see how this really adds up, and this is a huge reason why that 78% of Americans live paycheck to paycheck. The super wealthy know that after a certain point, a good life is not tied to what they spend their money on. So let's actually listen to Steve Jobs and what he has to say.
I was worth about over $1 million when I was 23, and over $10 million when I was 24, and over $100 million when I was 25. It wasn't that important because I never did it for the money. Especially at that point in my life, it was not the most important thing. The most important thing was the company, the people, the products we were making, what we were going to enable people to do with these products.
Steve Jobs really wanted to focus on his products and his passion, which was to build companies. And as a byproduct of this passion, then money would come along the way. And you also notice that he was quite pretty simple in his nature, he would always wear the same thing, which is a black turtleneck and jeans. So while your coworkers and your friends might continue to upgrade their lifestyle, I would actually encourage you to continually to live below your means and compound your wealth instead. And so what you want to avoid here is basically making six figures or more, but ending up in this cycle of consumerism and living paycheck to paycheck. So even today, I'm trying to do the same thing. So I've been keeping track of my monthly spending for the past 9 years. And I'd like to think that based on the data, largely my lifestyle has remained the same. As my income has increased, I do spend a little bit more money on some of the things I really enjoy. So I really like going to sushi. So I really spend a lot more money on that, as well as going out for coffee sometimes. I do go by the coffee name of Kevin. I'm sure you guys have seen that in my videos before. All right, mistake number 4 is being emotional about investing. So the best investors are long-term investors, and they're thinking about a long-term time horizon. So even with short-term fluctuations, they aren't really panic selling or really selling due to their emotions. Let's take a listen into Warren Buffett and his investing philosophy.
I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt it was important.
Google CEO and billionaire Eric Schmidt even goes as far to say that you should not even try to beat the market. In this article from CNBC, he says, quote, short-term trading isn't going to make you rich, and quote, don't try to beat the market, he says. Don't try to pick stocks. Instead, think long-term, invest in index funds and Vanguard funds. Now, this is the same exact strategy that Warren Buffett prescribes with most people, and that's the inexpensive strategy of investing in index funds. Now, if you're unsure of what that is, I'm going to leave a link down below with my How to Invest for Beginners guide. And in that video, I go over how to invest, what a passive index fund is, and why you want to invest. All right, mistake number 5 is wasting money on fees. So the ultra rich know that fees are a waste of time and money. It's more that they're really hyper aware of any inefficiencies in their personal financial life, and they're always paying their bills on time. So that means they're going to take advantage of features like auto pay to avoid late charges, and they're also really mindful of bank fees. Many banks will often charge you a service fee for having a bank account, which is actually surprising, but oftentimes you might get a $15 service fee if you don't keep a specific minimum account balance. So make sure you aren't making any of these mistakes when it comes to your own personal finances, because these fees will add up and compound negatively over time. Now, in terms of fees for investing, this is something that the ultra rich super pay attention to. The average expense ratio or yearly fee of a mutual fund these days is between 0.5 and 1%. That means on an investment of $1 million, if it's a 1% fee, you're paying upwards of $10,000 per year just to have your money invested in a mutual fund. Billionaires know that every fee will eat into their compound returns, and they're cognizant of every single basis point, which is basically a term to describe 0.01%. So take a look at this. The following chart shows an investment portfolio with a 4% annual return over 20 years when the investment either has an ongoing fee of 0.25%, 0.5%, or 1%. Notice how the fees affect the investment portfolio over 20 years. In 20 years, a difference in just 0.25% of a fee can reduce your gains by $10,000 over 20 years. And if there's a difference of 0.75%, it could reduce your portfolio value by 30 grand. All right, so that's pretty mind-blowing. Now, the last thing that most people should be doing is to sign up for my free newsletter. It's called Hump Days. It's a business newsletter that comes out twice a week, and I guarantee that you're gonna love it. So we just crossed 11,000 readers, and it's a simple way to get all of your business and finance knowledge in one place. I will leave a link down below for that. All right, so those were the money tips for today's video. I do hope that you enjoyed it. I will leave a relevant link to a video right here or right here for you guys if you're interested in more ways on how the rich invest. And thank you for being here. I'll see you guys in the next video. Peace.